stop what you're doing. Seriously, if you own or even just follow the biotech sector, you need to hear this. What happens when a literal life-saving commercial rocket ship collides head-on with a billion-dollar anchor of corporate debt? Last week, I ran ImmunityBio through 5 distinct valuation models, plus Warren Buffett's and Peter Lynch's ultimate investment checklists. And what I found completely shocked me. This stock's intrinsic value could either be a massive multi-bagger or, honestly, a flat-out zero. By the end of this explainer, you'll know exactly if this stock is a Buffett buy or a classic Lynch value trap. So let's just dive right in and unpack this wild, dual-sided story. We got to start our analysis on a very specific, crazy day, March 24th, 2026. Look, every retail investor's absolute biggest fear is waking up, checking your phone, and seeing your portfolio just deeply, inexplicably in the red. And on this day, pure market chaos erupted for ImmunityBio. The stock tanked from over $9 down to $6.50 in a single trading session. The panic was just staggering. A massive 53 million shares traded hands in just a few hours. This wasn't some gentle, everyday market dip, It was pure, unadulterated chaos. To really understand why this happened, we have to look at the timeline, because investors got some serious whiplash here. They were riding this incredible streak of brilliant clinical news. We're talking a positive FDA update on March 9th, inclusion in major medical guidelines on the 17th, and then an approval in Asia on the 20th. Everything's looking great, right? But then, bam, the momentum completely derailed on the 24th thanks to an FDA warning letter. And it was all over some misleading podcast promotions for their main drug, ANKTIVA. As we break down exactly how this unfolded, I'm going to give you a clear, actionable framework you can literally steal to analyze high volatility setups like this for your own portfolio. All right, let's get into Section 1, the bull case, focusing on their fast-growing commercial engine. Because to really grasp why this stock is so volatile, you have to see why people were so hyped in the first place. ImmunityBio has massive clinical momentum right now. They recently fully enrolled their QILT 2.005 Phase 2 trial, way ahead of schedule, by the way, with 366 patients. And the interim results for this bladder cancer treatment, they showed an absolutely incredible 84% complete response rate at 9 months. I mean, those are life-changing numbers. On top of that, the FDA just accepted their supplemental application to expand this treatment to even more patients. That sets up a major target action date, or PDUFA date, which is essentially the ultimate FDA report card day for January 6, 2027. And here is the kicker. This isn't just some clinical stage pipe dream that's only burning through cash. Their flagship drug actually brought in $113 million in revenue in 2025. It's exhibiting this massive hockey stick growth curve, pulling in $38 million in just the final 3 months of the year alone. So they are selling a real product and making real, tangible money. The crucial takeaway here is that they're actively scaling a global commercial rocket ship. ANKTIVA is now authorized in 33 different countries. They've recently locked down a major EU distribution deal with Accord Healthcare, and they're deploying a massive 85-person sales force across 30 countries. They even set up a brand new Irish subsidiary over in Dublin just to support this massive European launch. But of course, for every bullish commercial win, there's a heavy counter-argument. Let's look at Section 2, the bear case and all that heavy corporate baggage. And here is our very first major red flag. Just look at the sheer volume of shares outstanding. It is over 1 billion. 1,047,350,000 shares, to be exact. This really highlights the massive continuous dilution that everyday retail investors have had to endure. It's like a pizza, right? Every time they print a new share, they're just slicing that exact same pizza into smaller, less valuable pieces for the existing shareholders just to fund the company's progress. And the balance sheet totally reflects this ongoing struggle. The company is operating with a severe stockholder deficit. We're talking roughly $1 billion in messy, insider-tied liabilities and deals that basically sell off their future revenues. Compare that to only about half that amount, roughly $500 million, in actual assets. Guys, that is a heavily tangled financial mess. And honestly, the threat isn't even over yet. There's this massive overhang of convertible notes and warrants. If you're not familiar, those are essentially financial IOUs that can be turned into brand new stock at any moment. This overhang represents almost $500 million just waiting in the wings to potentially dilute the stock even further. It acts as this constant looming downward pressure on the share price. Which brings us to Section 3, the massive short squeeze setup. This is what happens when the market actively bets against all that baggage. Check out this truly surprising statistic. 41.53%. As of May 2026, a staggering 41.53% of ImmunityBio's entire public float is sold short. That represents some deep, widespread institutional pessimism. Basically, a massive portion of the market is actively betting that the corporate baggage is ultimately going to crush the commercial engine. Looking at the market beat data neutrally, it reveals the true jaw-dropping scale of this bet. There are 132.75 million shares sold short right now. That means there's over $1 billion actively betting against the stock. And based on average daily trading volume, it would take 10.6 days, so nearly 11 full trading sessions, for those short sellers to just exit their positions if they needed to. So, we have to ask a bold rhetorical question here. What exactly happens if that commercial engine produces enough good news to trigger a short squeeze against those 132 million shorted shares? Well, if the stock appreciates rapidly, all those short sellers are forced to buy actual shares to cover their positions. That creates a massive feedback loop, driving the stock price up even further and faster. The potential fuel for a squeeze here is incredibly potent. That brings us to our final takeaway in Section 4. The ultimate biotech tug-of-war between the engine and the baggage. Investing here basically means stepping right into the middle of a war zone, and it's exactly why those valuation models we talked about are flashing both massive warning signs and screaming buy signals at the exact same time. You get the incredible commercial progress on the one side, the high revenue, the EU expansion, the life-saving FDA approvals, but you are forced to accept the messy corporate structure and massive dilution on the other side. You literally cannot buy the engine without carrying the baggage.
So, I'm going to leave you with this final thought to ponder. In the long run, does the market reward the life-saving product, or does it strictly punish the financial baggage? Which side of this billion-dollar tug-of-war is ultimately going to win? Thank you so much for joining me for this explainer, and definitely keep a close eye on how this fascinating dynamic unfolds.